All right, all right. Let me just make sure my levels are working here. All right, good. My microphone's good. Let me just give everybody a minute to jump in. All
This
right.
thing.
What's up?
Hey, catching rockets. Are you
Yep.
about to do a webinar?
Yeah, I'm getting started in a second here. I'm just going to go over POCs, VPOCs, volume profile, value area. I'll probably get into like ad as far as trading SPY and watching ad or, looking for divergences as far as if you're in calls and ad starts going red, might be a good time to get out of the play, so on and so forth. Just kind of cover basics. I know Shorty tomorrow is going to do a class. I'm not exactly sure what he's going over, but I know we've got new people in the room, so I wanted to just do some basic stuff. So when Shorty's talking, things make more sense for people, or even just a refresher for older people. You know. But
Sounds great. One thing too, I don't know how many new people will be here, but one thing I've been having a little bit of difficulty with acclimating to is just like the live flow of the mornings when Shorty's kind of going and just some of the lingo he's using or that sort of thing. It's kind of hard to just jump into the mix if that makes sense.
yeah, it makes total sense. I mean, that's just going to be a matter of studying and learning. His lingo is all just trading lingo. So with time, just from hearing things being repeated over and over again, those things will start to make sense. And I mean, that doesn't sound super reassuring, but like I can't teach everything in one YouTube video, but as you hear the lingo more and you read books and study or watch more videos or whatever it is, all of that lingo will just start to click and make sense. It's just a matter of you know watching the right video that explains a specific term he's using, or whatever it might be, reading a book that covers it or something to that effect. I think the main thing I would recommend, and this is to everybody, this it doesn't matter your level of experience. We all, including myself, need to slow down. People are so hurried to get into a trade, and you don't need to be. Like, one thing I cannot emphasize enough is there's always another trade. Like, you don't have to jump in the first trade of the day. And I'll cover this a little bit more like as we go like into the video today, but it's one thing I definitely do want to speak on is you really want to step back and take your time and look for like those good entries. You don't want to just be like jumping into trades because you're afraid like you're going to miss the trade. And maybe you do miss a trade. So what? There's millions and millions and millions of trades, happening all day long that if you look for a good setup, it will play out in your favor if you just take a step back and watch and make sure everything lines up. There's no way to get a 100% trade. Like, there's no way to get a 100% perfect setup that's going to play out in your favor every time. But if you step back and look for your technical analysis, like look for a bull flag or a bear flag, and then draw it onto the chart and wait for that bull flag or bear flag to break. And then you make sure that the volume is there. You make sure that everything's lining up. That's when you take the trade. So you always want to just take a step back, not rush, not feel like, oh, I've got to take this trade, or, I'm going to miss it. And actually what ends up happening when you do that is you just run out of buying power. And you just end up playing like a bunch of crappy trades because you're rushing and trying to force trades. And really the way to go is to slow down, step back, look for a good setup, like do it yourself. Draw your bull flag, figure out where your entry is when the bull flag breaks. Make sure that ad is going in the direction, that your play is going in. Make sure that VIX is going in the direction of your play, or VIX would be the opposite direction. But I'm saying, like, if you're playing calls, you want VIX to be going red, or trending downwards. And if you're playing calls, you want ad to be going upwards. So you want to look at all of those things at the same time. And most importantly, make sure you have the volume on the specific ticker that you're trading to justify entering the trade. And so that really, like, the best advice I can give you besides like risk management is take a step back, slow down, don't try to force things, really take your time and look for that ideal setup. Make sure everything's going in your favor. Make sure you have ad going the direction you need it to be going. Make sure you have VIX going the direction you need it to be going. And make sure you have the volume on the ticker symbol that you're trying to take the trade on. And if anybody's on here and any of what I'm saying isn't making sense, we'll get into it more in depth a little bit later. Like I'll pull up, ad, and I'll pull up VIX, and I'll show you how those play into your trades. So all of this stuff should start to make sense as we get more into it. I'm just kind of speaking openly and crazy here. I do want to say before I start, for anybody watching, like, I'm not a YouTuber by any sense, so this is not like a high quality production. I'm not trying to be like an aspiring YouTuber or anything. I'm just trying to share as much knowledge as I can with other people, and hopefully help some people out with their trading. I do all right as a trader myself. I'm always trying to grow and get better, reading and studying constantly, and just trying to do the best I can. So let's look at some charts here. I don't know what to look at. Like none of this is pre-planned. I haven't looked at any charts where I can show you like, oh, some perfect entry I thought of and show you how it plays out or whatever. But we'll start off with VPOCs, and then we'll get into like volume profile. So hopefully this is a good chart. It's pretty good. So first I'll just explain POCs and VPOCs to you guys. So you can see here, so these yellow lines on my chart, these are going to be my points of control, which is a POC. All of these yellow lines. And what a POC is it's the area on a chart on any given day where you're going to have the largest trading volume that occurred. So that's buying and selling. It's not just buying or just selling. So if we look at December 13th here, the largest volume of trading, buying and selling, was right here at this yellow line. And I'll explain why that's important. So you, as a retail trader, if you were to buy shares here, I think most of the people that might be on this call are probably option traders, and that's fine. It doesn't change anything, but it's easier to explain with shares because when you take into account theta decay, that changes everything. We're going to sell way before people buying shares will. But so if you're a retail investor and you buy a bunch of shares here, you want to think about the psychology of that trader when they buy shares here and then the next day it tanks, right? Right now they're negative on this trade. as soon as it finally comes back up to this point, think to yourself, what do you think they'll be doing? I think most people will probably be right and say, oh, I'm going to just get out of that trade, break even, and take my money and live to trade another day. And if that's what you thought, you're correct. This is not a perfect example because we didn't really respect this area here, kind of shot through it. But as you can see, this is a very trending day where we just ripped up. So on trending days, you'll rip right through POCs or VPOCs without respecting them very much. But then you'll normally see them get respected more on another day. Here, the same POC, it's a little bit higher, is being respected. You can see touches here, touches, even a touch here. At this point, after you have 1, 2, 3, three touches on consecutive days, and then also 2 touches back here, this POC is no longer important. So we would just take this off of our chart because this point of control has been respected so many times that it's lost its validity, if that makes sense. But so you just want to think about yourself as a retail investor, and hopefully most of us are past this level. And if you're not, something to think about, you want to get past that level where you enter a trade and you enter a trade. Hang on one second, sorry. So anyway, hopefully as investors, you're past the point where you enter a trade and it goes red and your goal is to just get out, break even. You should always have a set, like, I'm going to take whatever, a 20, 40% loss. And you should always have like a 2-to-1 risk reward as a minimum. So if you're shooting for negative 20% as your loss, you would shoot for 40% as your gain. And that you want to be consistent with that. That's how you become a consistently profitable trader. But that's another video. I'm not going to get into that today. But so POCs, super important. As a retail investor, if you buy here and you go red, most people, again, they're going to be trying to sell at this same area. And actually, I'm sorry, I'm going to draw this POC back in really quick, because it actually was respected, but it was very brief. If you look here, if you pay attention to this candle and to this candle, so even though we've got like a massive trending day going on here, when we hit this POC, you can actually see on this candle with this wick, there was a ton of selling pressure. So a ton of people probably had stop losses from buying. Sorry. From buying back here. And even possibly people here, just taking profits. But these people buying here aren't really trying to take profits here because they didn't buy it at this price. So they're not, I mean, there might be a few people that are like, oh, a good place to take profit, especially when you start to see this selling pressure, on all of these wicks. There's selling pressure. That might be enough to get people to start selling here as well. People start to follow suit of what other traders are doing. But on this particular day, massive buying pressure, and then we start to see a little bit of selling pressure. And on this candle here, you see more selling pressure because people probably have stop losses set at this POC here. And then even here, we still have more selling pressure. And again, we're looking at 30-minute candles. So if I switch to like 3-minute candles, you would see more like consolidation in this area. But you guys can look at that stuff for yourself. But so we see a ton of selling pressure here. We see a ton of selling pressure here before the price finally took off again. And after that POC, it didn't really take off per se. This is what, like after hours, 181.26 from 178.65. So basically 3 points from here to here versus, the low of the day, 172 to 178. this is a 6-point move and this is only 3 points. But so you can see there is a little bit of respect here on this point of control. So the inverse is going to be, trying to see if we can see a good example here. I'm probably going to have to go to the 1 year, 1 day. Sorry, and I want to delete this POC I drew on here really quick. So so a lot of people looking here would call this support, right? We have a double bottom here. We probably see more upside afterwards. So we have a POC here, right? And so what happens is, if you're a hedge fund, moneymaker, these people don't chase price action. So if they place a large limit order here on Apple, for let's just say $500 million, they place a large limit order here, or a dark pool limit order here, and after they start getting filled, let's say they get a partial fill for 100 million, and then the price takes off. They don't move their order up to try to get a fill at a higher level. They're just going to leave that $400 million order, whether it be on the dark pool or retail or whatever else, waiting until price comes back down to this level, because they know, oh, right here, I have what is considered a virgin point of control, so a VPOC. And virgin point of controls are stronger than point of controls, because they basically, POCs and virgin POCs act as magnets for price. And so when you have a magnet for price, we know the price is going to come back here. Another thing that we know is gaps are going to get filled, right? You guys should already know this, but if we draw this gap on here, and again, this is not pre-planned. I have no idea if this gap has been filled yet or not. But so if we move this forward in time, we can check and see if this ended up getting filled. But so with virgin point of controls, and even with point of controls, but again, virgin point of controls are going to be much more powerful than a point of control. And hopefully I made myself clear. We'll look at a point of control in depth in a few minutes here, so I can show you exactly what the difference between virgin versus a POC is. And with a virgin point of control, we know price will eventually come back down to this area. It might take a while, but it's going to happen. It's inevitable. So here we have this virgin point of control. We have money makers, whatever, hedge funds, put in a large limit order on the dark pool or wherever for $500 million. They get a partial fill, price takes off, and that order is still there, waiting until price comes back down to that level. So what's going to happen when price touches this virgin point of control again? It's going to shoot back up because you have a large buyer in this area. So that's what we're seeing here. On a future date, price comes back down, touches this virgin point of control. We still have selling happening as well, but we have buying and selling. And buying outweighs selling. We shoot back up the next day. And then the same thing again. The following day, we come back down, buying outweighs selling, we shoot back up again. Because we have this large limit order that keeps getting filled every time we come back down and touch this virgin point of control. You can use POCs and virgin point of controls to really kind of predict where price will end up going, in the future, because you have, a pretty good, like a pretty accurate range of where it's going to end up going. Because, you know, here we're going to have large buyers, right? Whereas these POCs that are, higher up, those are mostly going to be retail, buying at bad prices. Um, those are going to act as resistance or as a supply zone, right? So generally, we'll reject from VPOCs or POCs up here, and we'll bounce off of POCs that are lower. Hopefully, that all makes sense. And like I was just saying, we'll look. So we haven't come back and filled this gap yet, but I'm telling you, if you plot this gap on your chart, this will get filled eventually. It's just a matter of time. Yes, Fibonacci Fox. So we'll look at POCs and VPOCs here more in depth, so I can show you guys exactly what the difference is between a POC and a virgin POC. So here, if we look at Apple, so on December 17th, this is going to remain a virgin point of control until at a minimum at least December, well, in this case, December 20th. So the following trading day. So this is a Friday, this is a Monday. So are the studies posted to map out the VPOC? Sorry. Spindrift, you'll get those on TradingView. On TOS, I'm not sure, but so this is volume profile. This is a paid indicator, the specific one I'm using, but I'm sure you can find like a free study on TOS that is for volume profile, which will show you your point of controls. But so, like I was saying, on December 17th, on this particular day, even though we have a ton of touches on this point of control, even after hours, we have touches, touch. This is still virgin until the next day. And if the price doesn't leave the next day, it's still a virgin point of control. It's not until price leaves it, like we do here, and then we finally touch it here. This right here is where it becomes a POC instead of a virgin POC. And you can see it becomes a strong support and resistance area. And then again here, December 20th, we have another virgin POC, becomes a strong support area, right? And then even here, we start rejecting again off of the POC from December 17th. So you can really start to see how powerful these are as you start looking at them closer. And it's something you should, like anything that you're planning on trading, you should have POCs on your chart and virgin POCs on your chart. Because if you take a trade close to one of these areas, like if I'm looking to take calls and I got in calls like right here, I'm probably going to reject. I mean, in this case, I'm sorry, this is the day of. So this is not important the day of. But, like in this instance here, if I took a trade here for calls, there's a good chance I'm going to reject off of this POC here. I might eventually break through it, but I'm probably going to see more rejections before I break through it like I do here in this instance. Okay? So, just to recap really quick, this is a virgin point of control no matter how many times it gets touched on the day that it's forming. It's not until we touch here on this red candle that this becomes a POC. Jace, so I guess it's just personal preference. So how I met Shorty was I literally just reached out to him on Twitter, and I asked him about his indicators, and he offered to do a one-on-one session with me and sell me his indicators, and so I bought them for him. I'm sorry, I bought them from him for TOS. Anybody that wants to buy the indicators from Shorty, you can reach out to him, either in Discord or Twitter or whatever that might be, and you can buy the indicators for him from him if that's what you want to do. But so I do use the indicators on TradingView, and I also use them on TOS. I like to trade on TOS, and I also have TradingView open to look at different things while I'm trading. And I actually use a combination of both. But when I share my screen, I'm normally just sharing TOS. I mean, I can show you my TradingView. I have so I have them here as well, right? You can see my volume profile, cloud VWAP. I've got quite a bit of stuff on here, actually. Too much right now. I normally would not combine those. But yeah, so you can see here I have everything. Same thing you guys all have if you're in the Discord. Anyway. Yes, Options Addict. If it gets touched, I mean, it depends on exactly what you're talking about. So, for instance, this POC here, and I'm sorry, the question I'm answering was, does it remain a virgin point of control if it gets touched in after hours or pre-market? So if we're looking at December 17th here, all of these touches, including these ones after hours, it's still a virgin point of control. The touch here after hours, like the following night, now it becomes a POC. Hopefully that makes sense. So you're looking at the day that it's being formed. It can be touched after hours and pre-market. It can even be touched on the day of. It's once the price leaves that area and comes back to it and touches it that it's no longer a virgin point of control. Okay? Because the price has to actually physically leave it like it does here. We've left this value, this POC right here. We're done. We're very far away from it. And we eventually touch it here. And here it becomes a POC. No, future dates still matter in PM and after hours. Okay? All right. Sorry, I'm just checking questions really quick. I know I've got a lot of questions. I think I've covered everybody. If you ask me a question and I didn't answer you, please just ask it again. I'm not trying to ignore everybody. Or I'm not trying to ignore anybody. So hopefully everything's making sense. If this isn't, reach out to me. I don't care from where. If you're in a Discord server with me, DM me or ask me in the public channel. Yeah, I can't even see you, Sequence. If you're watching this on YouTube, reach out to me on YouTube. If you follow me on Twitter, reach out to me on Twitter. It doesn't matter. I can explain these things more in depth. I would just say don't overcomplicate it. For me, in TOS, I draw a price level. I choose gold because it matches the color of my POCs on my volume profile. And I always just extend it for like the whole day. And then I'll label them, whatever it is. And you can label it however you want. So that way, when I'm looking at it on future dates, I can see, oh, this particular version point of control is from December 12th. Because once point of controls are about a month old, they start to lose their validity or their strength. Like they're not as strong of magnets, and they won't act as such strong like support and resistance zones. You will still see them act as support and resistance, but after that 30-day period, it's not quite as dramatic as like a newer one. If you have a newer version point of control, here, and you see a big sell off and then it comes back to it within like a few days, you'll generally see a very big rejection at that version point of control when it's just been a few days where it left and came back to it. So for me, version point of controls and POCs is literally like one of the most important things you can have on your chart. And after they stop being respected, I'll just start taking them off. You can see here December 22nd. I need to update this. This is not a version point of control anymore. It's been touched a lot of times, but it's respected here. It's respected here, respected here. We leave it, we come back and we respect it again, respect it again, respect it again, respect it again, leave it, come back to it another day, respect it again. I'm not ready to take this off. For whatever reason, this POC is really strong. If on a future trading date we just rip through it, then at that point I'll be removing it from my charts. Yeah, I'll be going over value area in just a second. So you can see, just looking at this December 22nd POC, how extremely strong they are. You have support. Actually, it's support here, support here, support here, support here, support here. Finally break through it, right? And then we have resistance, 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 resistance. Finally leave that, come back down, resistance, leave it again. And then this POC from December 17th, we have support, support. And it just keeps on going over and over. So that's why it's super important to have these drawn on your charts. It can really help you with where price is going. December 29th, again, this is no longer a virgin point of control. I haven't looked at Apple recently, so anytime I look at a chart, I'll remove stuff that's no longer significant, like this December 23rd VPOC, which again is not a VPOC. I would probably remove this off my chart today. We have touch, 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 and then we leave it. I'm guessing the next time we come back to this level, this area here is going to be our new virgin point of control that's going to be respected, whereas this December 29th point of control will not be respected. And so this will be January 5th. So this should be making a lot of sense to everybody right now. December 29th, you can see just reject, reject, bounce, 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 finally break through. But it took so many touches of this level to finally get through here, right? So you have a large buyer in this area. All right, so that should be enough about VPOCs and POCs. Hopefully everybody understands those. And now we'll go over our value area, and also at the same time we're going to be discussing the volume profile. For me, volume profile, POCs, and value area are super important for trading. And I'll explain why here. So actually, I'm going to go back. Oh, I'm sorry. There's one thing I forgot to cover on POCs. POCs, you want to draw them in on the 30-day, 30-minute time frame. So like you can see if I jump to like the daily chart they won't line up. So the time frame actually does matter. So you can see here, like, this POC is way down here when on the 30 minutes it's up here. The 30-day, 30-minute ones are going to be respected more than the 1 year, 1 day, or any other time frame. Sorry, I almost forgot to cover that with you guys, and that's super important. But so, volume profile. Actually, I want to look at this day here. I want to look at these 2 days, actually. So we have two patterns here. If you look at the volume profile here, which is this gray shaded area, I'll actually zoom in a little bit more on just this specific day. It might be a little bit hard to see because it might blend in. Actually, let me do this. That's what I'm looking for. There we go. So now this should be a lot easier to see. So here, my volume profile, if you look at it, it's shaped like a lowercase b. Lowercase b's are generally going to be bearish, and you'll generally see downside. And again, with stocks, there's no 100%, but you're generally going to see downside when you have a lowercase b, and when you have a p, lowercase or uppercase, it doesn't matter. You'll generally see upside on that day. The way that I like to think about volume profile is you want to think of these there. So this area here where it juts out is called a volume shelf. You have another small volume shelf here, but this volume shelf is nothing compared to this one here. And so what your volume shelf is, it's going to be buying and selling. And the more buying and selling you have at a specific price, the larger that volume shelf is going to be. So here in this area, we have just a ton of buying and selling happening. So if we were to draw a line really quick just to kind of highlight this area, most of our buying and selling on this day is happening right in here. Okay? And this blue shaded area is actually called the value area. And the value area is where, I mean, depending on who you're talking to, it's either going to be 70% or 68%. For my purposes, it's going to be 68%. So I should be able to click on this. Yeah, so you can see my value area is a 68%. 68% of the trading volume on any given day is going to be highlighted in blue. The reason that's important is if you look at this blue area, you literally just have sloppy consolidation, right? And it's not until we break out of this value area that we're able to like see some actual movement. If you try to trade in here, you're just going to end up chopping around. There is 80% rule on the value area, which is if you touch this side, 80% chance you're going to come back up and touch the other side. And that's when you leave the value area and come back into it and touch, 80% chance you're going to come back to here. But for me, I don't even worry about that 80% rule. I don't try to trade too often in the value area unless I think I'm going to be breaking out of it. So like, you know, here I might be like, oh, we're really close. Maybe we're going to break out of the value area here. I might take a play early to try to catch this move. But I'm not going to be like buying here at the bottom to try to catch a move to this side. I'm always trying to take the plays when we're either outside of the value area or we're close to breaking out of the value area. This particular day is just not a good day for an example of trading. If you tried to trade on this day, more likely than not, you're going to get caught up in chop, unless unless you also take into consideration volume. I'll get into this in a second. But so what I was saying earlier is you look at these volume shelves. I like to look at them as actual stairs. So if you think about, the laws of physics, might seem strange, but the laws of physics actually also apply to stocks. If I have a volume shelf, or like I like to refer to them as a stair, if I jump onto that stair, I have something I can land on, a support area, where if I jump up onto it, I can land there, and I'll be able to stay there. And if I have another stair above, I can jump up to the next stair or step up to the next stair, and I can stay there. And so every time I have a volume shelf, I have something to support me that I can stand on. Same thing with stock price. If there's a volume shelf, the stock price has something to support it that it can actually stand on. So as you can see with this volume shelf here, we just boom, 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 boom. We're being supported by it all day long. We'll look at some better examples where we have different volume shelves, and you can see it move from one to the next. And it'll, as long as there's something to support the price, it'll stay there until it moves to the next volume shelf and stay there. If we're to look at volume, and I'll show you guys really quick for anybody that uses TOS, this particular study is volume average. So if you search, it'll come up. And what this is like a 50-day moving average combined with the volume. And if your volume is above this, more often than not, you're going to have enough volume to take a trade. So if you're watching, that here, we don't have enough volume to take a trade, even though we left the value area. Here, we don't have enough volume to take the trade, even though we left the value area. Here, not enough volume, even though we left the value area. And this one candle here, boom. If you took this, you would have to be quick. I mean, this is a 30-minute candle, but if you took the trade here, you're seeing a big enough movement, if you're a breakout day trader, to take a trade here and sell somewhere, take trims or whatever, or once you start seeing the selling pressure, to get in and out of this trade and make money. Sorry, 1 second. And again, same things here. You have volume here, volume here. Any of these, you have enough volume to take a trade. And actually, I'm glad that this is showing here for more experienced traders. And if you're not a more experienced trader, that's okay. This is all about learning. If we look here, we're just going to take the tops of these candles, or I should say the bodies of these candles. We're trending upwards, correct? But what's happening with volume? So if you're taking calls here and your volume is trending downwards, but your stock is going upwards, that's a volume anomaly. And you should be looking to exit that trade. Anytime that you see a volume anomaly, you're normally going to have a reversal, which is exactly what we see here. Price is trending upwards, volume trending down. Eventually it reverses and goes back down. So you want to watch for these when you're trading. Volume is super, super important. For people in Shorty's Discord, you know this. You should be looking to... you should read Volume Price Analysis by Anna Cooling. Super good book. It's a little bit hard to digest. But if you understand volume alone, you can trade with nothing else on your screen and only trade with volume, and be a successful trader. Obviously, it's better to incorporate other indicators and what have you, but just understanding volume alone is enough to make you a profitable trader. So watch for these things when you're trading, when you're in trades, volume trending down, price trending up, or if you're in puts, price trending down and volume trending up. You're normally going to see a reversal happen. So now let's look at another day for our volume profile here. And you have to remember, these things build, this volume profile, it's going to be building out as the trading day is happening. But if we look here, in the morning, it looks like we're starting to build a little area of consolidation here, right? We're not going to look to trade in this area because we need to move out of. And if you take your time as a trader, and if you were to draw a box here, actually, I think this is pre-market. Anyway, it doesn't matter. Looks like this is pre-market, but all of this consolidation here, we're not trying to trade as breakout traders. We're not going to get, we're not going to get a move here. But so if you draw a box around this area, the second you or break out, a lot of times it's better to wait for a retest. But when you break out of this area, that's where you want to be taking trades. And if we're looking at the volume profile here, so like I said, a P is going to show you upside. A B, you're going to see downside. So on this day, we have a P shape, correct? And so what happens up here, actually, I'm not going to draw a line. You can just look at the value area. We have a volume shelf here. And down here, we have nothing to support this stock. So the price can easily jump from this low value area up to this high value area, this high volume area. And once it gets here, it's just going to start consolidating because you have this shelf, right? Or stair, this area that's able to support the price. We could see price go up here. Whoa. And then if it comes back down, we're not going to be looking to try to take a trade in this area here, because there's a good chance that this volume that's taking place is going to be enough to send it back upwards. But once you break out of this value area, you have nothing to support this stock. There's no volume to make it bounce or reject. It's just going to fall back down. You might see a bounce at this December 29th VPOC, but this is now a POC. But you might see a bounce here at this POC. But for most people, from 180, 181-ish to 179.50 is a good enough move for most breakout day traders. So you have a good trade here if this did happen. If you broke out of this value area, you can either take the trade when you break out of the value area or slightly before, or you can wait for a retest of the value area. Just depends on what kind of a trader you are. If you have a higher risk level, you can look to enter the trades when you think it's getting close to breaking out. If you have like a moderate risk, you can take it as soon as you break out. And if you have a lower risk, you'll wait for the retest and then take the trade. So hopefully right now, volume profile and POCs, points of control, are making sense to everybody. Here we have a lowercase b. And actually this is a good example here. So I will if we take this area here, right, this is all consolidation, right? So we're not looking to trade in this area. And again, depending on your risk level, this is where waiting for a retest is better. But then again, if you're waiting for, oh no, I'm sorry, waiting for a retest here would have paid out for you. So if you took a trade as soon as you broke out of this consolidation area, or even like an opening range breakout, you would get, like if you're doing a 30-minute opening range breakout, this would be your entry. There's enough upside here to make money. But then once we come back down to this consolidation area and we've got this small volume shelf that's forming here, we're not going to be looking to take a trade in this area. We're going to bounce around. And again, if you're doing the retest, you're not taking a trade here, especially with all this buying pressure. And again, here, so much buying pressure. Boom, you take the trade here, buy puts. You have a nice move all the way back down to this volume shelf, right? And then once we get to this volume shelf here, without even looking to the right, most of my consolidation is going to be happening in this area here, right? And I'm going to erase this one really quick. What do we have here? Literally lines up almost perfectly with the largest area of this volume shelf. We have a virgin point of control, right? And we're touching, rejecting, or I'm sorry, bouncing. And it's very hard for us to break through this area. We have a volume shelf that's formed here, and we have a strong VPOC that's acting as support, right? Or a stair that's acting as support. That's very difficult for the stock price to get through. Even though it keeps trying to break through this area, it just really can't. I'm going to pause for a second here and just see if anybody's having questions about volume profile, POCs, or the value area. All right, I'm not seeing any questions. So Lex is asking, does the volume shelves created by the volume profile play into supply and demand? Yeah, of course. Supply and demand is just basically buying and selling. And so the volume profiles are formed by buying and selling, or volume shelves are formed by buying and selling. The area on any given trading day where you have the most buying and selling taking place is where you're going to have volume shelves that form. Busy is asking, so is this the only indicator that you have on your chart when trading? When I'm trading, my main focus is, let me give you an example. Well, first, I wouldn't be looking at the 30-minute time frame. I'm trying to find like a non-biased example. So for me, I pretty much trade on the 3-minute time frame. I think here's a good example. On this day, like I'm not looking to take a trade anywhere in here, right? Where this big volume shelf is, where all this consolidation is happening. Um, I'll throw some drawings on, and I'll be looking for a break of this. Actually, probably here is better. Yeah. So I'm going to be looking for a breakout of this technical analysis here, but I'm also going to be looking for the safer entry. So, your safer entry is going to be where you last touched this pennant or whatever it is. So right about here, or actually here. And what's disgusting about this is, this lines up perfectly with this consolidation area that I drew, right? So the break of this pennant isn't enough. I'm also looking for the safer entry is going to be this last touch of the pennant before it actually broke through it. But also, since I have so much consolidation happening in this area, I'm going to draw a consolidation area, and I'm going to wait until I break out of this consolidation area. And if you're really paying attention, this is where this gets just deadly disgusting. My last touch is here, so I already know this is going to be my safe entry. Based on this volume shelf, I drew in this consolidation area. I'm not even looking at I wasn't even looking at the candlesticks. So if we go back over here and take a look, sorry, I'm trying to get to, the largest area on my volume shelf is from here, the top, down to here, right? So if we go backwards a little bit, you can see the volume shelf is still here. It's just tapering off. So for me as a trader, I just determined this is going to be the most important area of this volume shelf, where it starts tapering off here. I don't have as much volume buying and selling taking place. So for me, this is a safe entry, a breakout of this consolidation area or this volume shelf here. And everything just happens to line up. This is not, again, I didn't plan this. I didn't, draw this in advance. I have a pennant here that's formed. I have this consolidation area. I have a volume shelf. My safe entry is going to be the last touch of this pennant. It happens to break here, but I'm still within this consolidation area. I still haven't quite crossed my safe entry. This wick would be enough that I'm not trying to jump in right here. But on the retest here, this is where I'm looking to get in. Here I have buying pressure. These are 3-minute candles, so it's not a ton of buying pressure, but there is buying pressure there. But this candle here, this is going to be my retest. This is the break of that volume shelf, this consolidation area, this pennant that's formed. This is the safe entry right here. Boom. Take this trade to the downside. Yeah, and you're golden. This, for most breakout day traders, this is a big enough move. For a lot of people, 20%'s enough, and you're good from here to here. Whoops, sorry, wrong drawing tool. 20%'s enough, you're good from here to here. Greedier people will be shooting for, something like this. If you're a newer trader, it's way better to keep banking those 20% gains and get those compound interest working in your favor. Once you have a larger account size, then you can start looking to you know, whatever, buy 20 contracts of something, sell 18 of them at 20% and leave 2 runners and try to hit 100% on those that are all, free, profit, no risk. So hopefully that makes sense to everybody there. So that's how I trade. I take my time. I'm not rushing anything. I step back just like I was telling you guys. I'll draw out, I'll draw on my chart and I'll look for a break of that area. Like here's another perfect example. If we're trying to trade this day, I have a good size volume shelf here, right? So first things first, without even looking right too much, I have to look right a little bit. If I draw in the main area of where my volume's taking place, this is going to be the area that I'm not looking to enter trades, right? And now I just need to, since I was trying my best not to look right, now I'll stretch it out. So we do have breaks of this, but it's mostly just wicks. And again, if you're waiting for your good confirmed entry, I'm sure these wicks won't be buys. You might have taken it here, but let's just draw out our pattern here. Even if you incorporate those wicks there, I don't know, something like that, give or take. On this, we're not bullish or bearish. We're just waiting for a break either direction. But we're also waiting for a break of our consolidation area here, right? And what's our safe entry going to be on this? So to the downside, our safe entry is going to be right around here, right? And to the upside, our safe entry is going to be here. And like, you can't make this up. Like, if you took this break here of just the pennant, you're probably going to get faked out, right? If you're a grittier trader, you might not get faked out. But if you're waiting for like an actual break of the safer entry here, like, you're golden. This is an ideal trade. Like if you took it from here to here, even to here, like, you're making a ton of money. You're good. So that's how I trade. I really try to step back. I'll draw up my consolidation area. I'll draw my technical analysis. I'll make sure I have volume. We weren't even looking at volume on this. We were just looking at price action and the consolidation area. But if you're looking at volume, so again, our safe entry is here, correct? This is the candle that you would be buying on. And look at the volume on this candle. And then what's our volume doing after we bought? Like, we're good here, right? We're still good. Starts trending down a little bit, but we're still good. We're above our 50 moving average here, and then we go sideways again on volume. We're still good. Oh, volume's going up again. We're still good. Like, actually, if anything, the volume told you when to get out of this trade. Here you're seeing lots of selling pressure. You have a red volume candle. Like, you can easily get out at this POC. And this is a good enough movement for most people from here to here. A lot of people will be happy here. If you didn't get out here, this candle is your warning to get out. All this selling pressure that's happening right here. Hello, drawing. That right there is telling you to get out of the trade. And then what happens? We have volume trending down, correct? And price is also trending down. If you didn't get out up here, hopefully you were smart enough to get out here. But so that's how I trade. Really, I talked about this earlier. Um, you can't give enough emphasis to taking a step back, taking your time, drawing out your technical analysis, um, and making sure that everything is in your favor. Um, Draw your consolidation areas. Wait for that retest. Will you miss trades waiting for retest? Absolutely, you will. Um, but the trades that you do take, you're probably going to be better off for waiting for those retests. You'll get faked out a lot less, and you'll probably have much more successful trades. Let me take a look at the questions again really quick here. So a recent POC invalidated by going through a newer value area. Correct. I'm not really understanding what you're saying, Daniel. Um, so I'm not 100% sure about what you're asking me, but I'll just try to answer it based on what I think you're asking. And if I'm not answering what you're trying to ask me, just ask again. For me, a POC is not going to be invalidated until it's not being respected anymore. So, if I look at this POC here, when this touched here, I have selling pressure. It's being respected here. It still got broken through, and that's fine. It's being respected here. It was respected on this candle. It's respected on this candle. Finally broke back through. It's respected again here, right? Respected again here. Respected again on this candle. This candle's respecting it as well. This candle's respecting it. This candle's respecting it. This candle's respecting it. This candle here is respecting it. And if we go forward to here, we're respecting it, respecting it, respecting it, respecting it, respecting it, respecting it, respecting it. It's not going to be until, the price just like moves right through it. Wow, sorry, I didn't mean to do that. That I'll take it off my chart. But so, like at a future date, if the price action just soars right through this December 21st POC, that's when I'll finally erase it from my chart. But if I see bounces or rejections happening off of a POC, I'm not going to take it off. Yes, Daniel. So if I have a POC, so now I understand what you're asking me. So here's a good example, right? So I have a POC here, right? Whoops. I can't draw right now. There we go. Close enough. I have a POC here. I have a POC here. I have a POC here, and I have a POC here. This POC, this POC, this POC are not important to me. Because, well, actually, I'm sorry. This December 29th POC is important to me because I keep seeing it being respected. Once it's not being respected, I'll take it off. But more likely than not, this POC is actually being respected here and not back here. I mean, if anything, you could draw in, pick your range, look at your volume profile, and you could say, in this area, like, I'm just not even trying to take a trade until all of this sloppiness here is not just one big consolidation area. Right? So hopefully everybody's up to speed with this. Hopefully you guys also understood how I trade. It's I mean, really, like, I can't emphasize this enough. Take a step back, slow down, look for your setups. Like, I cannot emphasize that enough. Do not FOMO into trades. Don't rush to take trades. You don't have to trade the first 5 minutes of the day. There's going to be tons more opportunity to take safer entries, where your probabilities of having a successful trade are going to be much higher. So if you're rushing into the first 5 minutes of the day, like, let's look at this day here. If you're going, wow, I've got a red candle, let me buy puts on Apple, you're going to get chopped out here, right? If you're going to say, let's see, let's just call this an inside bar. It's close enough. So this first candle opens and you're like, oh, I'm going to do like an orb inside bar breakout and take the high or the low of the second candle of this inside bar. And here, here's your high and here's your low. So the minute you break above this, you grab calls. Yeah, you could have made a little bit of money here. Theta is going to eat you up as well. This is not like a good play. It's not, you're just like, to me, you're just trying to force a trade. Unless you have some other confluence, like if ad starts ripping up and SPY's ripping up and you're like, oh, break of this inside bar. If I have volume, I'm going to take calls. I've got SPY going green. I have ad going green. Let me take this trade. Like, yes, that makes sense. But just based on this inside bar alone, no, this is not a good trade. And based on volume, and I'm guessing actually this is pre-market here. Based on volume, like, you don't have a trade here. We'll just pretend this is not pre-market. If you draw in, your consolidation area here, and you look for a breakout of this consolidation area, this is a great trade. You have volume. You have a huge volume spike here. And you just rip through POCs like they're nothing. This is going to be a great trade. But you want to step back, draw that consolidation area on your chart, draw your technical analysis, look for the safe entries. Let me see what you're saying, DP. So Amazon upside next VPOC, the 3328.75 from a few days ago. Sorry, I'm looking at the big picture here. I mean, we're eventually going to get to this level. I don't think it's going to be like Monday. Looking at the big picture, like, there's nothing screaming to me that we're going green. If we look we're in a fib channel here, right? Nothing is screaming upside to me. If anything, will probably come down to this fib channel and then go back up. Actually, right now, while I'm thinking about it, you want to always zoom out on your charts. When I'm charting, I always start on the 10-year month, and I look at the big picture. So this here was pointed out by Shorty. We have like 16 months of consolidation in this area. When we break this area, whether it's to the downside or the upside, I mean, it's going to take a long time for us to break out in one direction or the other. But when it does happen, we're going to have a huge move either to the upside or the downside on Amazon. And then I'll go down to the 3-year week, and I look here, see if there's anything, screaming at me on the chart. Double top here. Then I go to the 1 year, 1 day. I've got my fib channel here. Again, I'm looking, is there anything super important going on here? I'll always draw in gaps until they've been filled. This gap has already been filled, so that's not on my chart. And then I'll go down to the 30-day, 4-hour. And this is where I start looking for, like bull flags, bear flags, pennants, whatever. I mean, of course, I'm looking for all of those on the higher time frames as well, because those will play out eventually. And the higher the time frame is, the bigger move I'm going to have when that, whatever that technical analysis is broken. But for the next day, I'm generally looking, like at the 4-hour, 2-hour, 1 hour. And on the specific trading day, so here on the 1 hour, this is the kind of trading that I do. So right here, we have a bear flag, right? And so I'm going to look, to enter this trade, the safe entry, which is going to be this touch here, where I'm below this POC, and this is the last touch of that flag. So I'd be looking at this, like if this trading day hadn't taken place, and I notice this bear flag, I'm going to try to play it the next day. If it plays out pre-market, it is what it is. But so that's how I do it. And then during my trading day, I do the same thing, but I'll be doing it on like the 3-minute, the 5-minute, 10-minute, 15-minute. I'll start looking for whatever, consolidation, bear flags, bull flags, pennants, triangles, and I just start looking for breaks of those areas. The last thing I want to talk about really quickly is going to be AD and VIX. So let me just pull these charts over really quick. So I always have these up on another screen. I'm always watching SPY. I'm always watching Qs. I'm always watching ES, NS, AD, and VIX. I even have, ES, NQ, VIX, QQQ, SPY here, so I can watch the net change as the day's going. Let Actually, let's make this big. Add. If you're in Shorty's Discord, you should know what this is, but it's your it's the advancing versus declining stocks in any given trading day. Actually, yeah, it says it. Whoa, where's my cursor? New York Stock Exchange advancing issues, declining issues difference. Anything above 750. So this is going to be the number of stocks that are trending up on any given day or trending down on any given day. So anything over 750 is going to be considered bullish. Anything below 750 all the way to 0, or I'm sorry, 750 down to 550 will be consolidation. And anything from 550 to 0, consolidation, 0 down into the negatives is going to be bearish. So I like to watch add as I'm trading for confluence for my trades. So like if I'm taking calls and ads doing this, I know I should probably be getting out of those calls. And if you watch SPY or SPX and add at the same time, you'll see they really correlate with each other. If SPY is going down, ads generally going down. One good thing to look for as far as getting into trades is like if ad is going down and SPY is going up, you have divergence. SPY is probably going to reverse and start selling off. So that might be a good time as it's rising up to jump into puts and get them cheap. But as long as ad is selling off, you're good getting into puts on SPY or SPX. Inverse, if SPY is trending upwards. Sorry, I'm going to close my window really quick. I got a leaf blower outside. Give me 1 second. Very nice of my gardener to decide to come today. So, again, what I was saying, if ad's trending up and SPY is going down, good time to jump into calls to get some cheap contracts and see some upside. But again, you also want to look at volume and your technical analysis, and you're not just looking at one thing and jumping into a trade. And then VIX VXX is going to be this is VIX kind of tends to trade sideways for the most part, but when VIX is going green, it's really inverse to SPY. If VIX is going green, SPY is generally going red. If VIX is going red, SPY is generally going green. So again, it's just one more confluence point to look at. If you're looking to take calls on any given stock, you generally want SPY to be going green. You would want VIX to be going red or trending sideways, and you want AD to be going green as well. So for me, this is just one more confluence point I look at before I jump into a trade. If I'm looking at calls, is VIX going red? Good. Or is VIX red at the moment? Is AD green or going green? And again, do I have volume, so on and so forth? Is SPY going green? Probably will be safe to enter calls on whatever ticker it is you're looking at. And so that's how I do it. That's how I trade. It's a lot of information. I'm not really sure how long we've been going, but probably more than long enough. But so like I said, let me just check questions really quick, make sure there's no questions in the Discord here. Oh, for on Amazon, what's the next VPOC up or down? Well, let's jump back over to Amazon. I mean, so I haven't drawn the latest. So the latest VPOC is here. This is no longer a VPOC. And actually, this is a really good example for me to show you guys really quick. So, this is the VPOC forming here, and we also have pre-market, after market, or after hours and pre-market. Actually, I should turn those on before I speak, because I can't see. There we go. So on this candle, we've left this virgin point of control. We opened here, sold off and touched, bought back up, sold back off, closed here, right? So this touch here is where this becomes a POC versus a virgin point of control. So the next levels I have is going to be, we have a POC at 3,334.15. Actually, this is off a tiny bit. Sorry, this tilts my OCD. But sometimes I'm in a hurry to just draw these in. We have a VPOC here at 3350.48. And we have a POC at 3375.25. And then we have a VPOC up here at 3407.72. So. Hopefully that answers your question, DP. Anyway, I think that's going to cover it for this video. Like I said, if anybody does have any questions, not one at 33.29. I don't see one. No, I don't see one. If you're looking at DP, if you're looking at TradingView, the volume profiles are slightly off compared with TOS, just based on the way they calculate the volume profile. So if you're looking on TradingView, our volume profiles will not be exactly the same, and it doesn't really matter. Those POCs, you know, they're respected within a range, so you're not looking for pinpoint accuracy to the penny. They're you know, you're looking for that range, and those ranges will be respected. You know, when people draw support and resistance on their charts, they're generally drawing boxes that cover an area. So when you're looking at a VPOC or a POC, you're kind of in your head, there's a little box around that area. You know, wicks are going to cross through it, candlesticks will cross through them to a little, you know, a little bit, but in that general area, you're going to see support and resistance. So, and yeah, I know what TradingView shows. Like I said, I use TradingView as well. I use both. I'm sure if you want to get, if you want to draw your point of controls on TOS, I'm sure you can find a free indicator. You're going to want to look for volume profile, not for POCs. So look for a free indicator for volume profile, and you know, it'll show the POCs within that volume profile. And then if you do that, I'm sure your POCs will line up perfectly with the ones I have in TOS. But your ones in TradingView will line up perfectly with the ones I have in TradingView. But again, it's a range. It's not pinpoint accurate. Nothing in stocks is pinpoint accurate, but you can you can guess pretty accurately where the price is going to go with virgin point of controls and point of controls. Indifferent DP. They're both accurate. So I just I like to have my POCs in trading in TOS because that's where I trade. I use TradingView, but for different things. During the trading day, I have it open. I'm looking at it, but for different things. I mean, you have to figure out the style that works for you. So when I'm actually using TradingView, I'm normally looking at inside and outside bars on different ticker symbols. And for TOS, I have my volume profile, my POCs. I'll draw my technical analysis in TOS, and that's just what works for me. But it took time for me to develop what works for me. So you have to develop what's going to work for you in your trading style. And again, I mean, if you're interested in having this stuff in TOS, you can buy these indicators from Shorty, but that's something you have to discuss with him. I can't help you out with that. But if you're looking, like I said, just to get the volume profile, you can probably find, or I'm sorry, if you're looking just to get the point of controls on TOS, you can probably find a free indicator for volume profile that will have the POCs, and you can draw them in. You could possibly ask Shorty if he would be willing to share his. I don't know if he would or not. I have no idea. Maybe he will, maybe he won't, but asking won't hurt. And yeah, but you probably can find a free one. But so I'm gonna end the class here. Like I said, for anybody that has questions, feel free to hit me up on Discord. It doesn't matter what Discord server you're in. Hit me up on Twitter, or ask the question on this video, and I'll get back to you. All right. I hope everybody has a good rest of your weekend. Good luck next week on your trading and in the future as well. Much love to everybody. Take care, and I'll talk to you all later.